Well, the government, it reopened and the market's not taking it so well. We are seeing a little bit of a sell-off in today's market. And so I've brought in Jim Welsh from Macro Tides to talk all about this. And actually, Jim, you're going to talk a little bit more about other things based on some comments that some of our
Yeah.
viewers have asked, right?
Yeah. You had mentioned last week that if people wanted us to take a look at some other markets, that we would make an attempt to do so. We're going to take a look at Bitcoin, both short term and long term, as well as crude oil. And we're going to do our usual stuff first, but we just wanted to let people know that we're going to cover those other two markets today.
Awesome. Awesome. Well, I'm sure it's going to end up coinciding with the 4-year cycle and halving process of Bitcoin. I'm joking. I'm joking. Probably not.
What?
But for those of you that follow Bitcoin, you might be going, "Hey, I seen
Well,
what
we
Jim has." So,
yeah, we touched on it late at the end of last week when you brought it up. And my comment was, I think it's going, like low 90s.
and
So that was a preview.
that was all right. Well, Jim,
Yeah.
we're going to get to that, but
Yep.
really quick before we
Yeah.
get into your charts, is this a case of buy the rumor, sell the news? Because that's the way I look at it in today's market.
I do think that's part of it, Blake. And you didn't have other news to kind of bolster the market. Instead, we got more concerns about the amount of funding going on for AI, data centers, the whole shebang, debt levels. I talked about this in length. I reviewed the artificial intelligence story, if you will, in the November macro tides. If someone would like to read that, send me an email, jimwelshmacro@gmail. I'll send you the November macro tides because I did a deep dive. And some of the points I raised in that letter, which went out on November 1st, are already coming to fruition. And concerns about debt, whether or not they're going to really see enough revenue growth and so forth. And some of those things kind of reemerged. We saw, kind of a quick decline last week. Then we got a rebound, the reopening, on Monday. Didn't follow through to your point of selling on the news. And I just think some of these other stories have reemerged. In addition, last week we talked about it. I said, I think it's unlikely the Fed will cut rates in December. Well, since we talked last week, there's been, I think, at least 5 Fed governors who have given speeches, some of who voted to cut rates in October have come out and said, you know what, I'd be hard pressed to do that again in December. So you've got a lot of things kind of coming together, that I think is causing people to, do some selling.
All right. Well, speaking of selling, let's take a look at the S&P. You brought your first chart, which looks like what you're trying to say here, Jim, is things are a wee bit overbought, even after the sell-off that we've seen today.
Well, this is a long-term chart since it goes back to what, 1930?
Yeah.
And, it's kind of like, okay, not seeing the forest from the trees. The point of this chart is to kind of say, hey, folks, it's easy to always get caught up, especially short-term traders, in what's happening in the very, very short term. At the same time, if somebody's an investor, this is the kind of chart that should appeal to them from a standpoint of the S&P chart on the top. There's a thin line that goes through, kind of like the trend going back to 1930. And what we're seeing is peaks above that trend that are being circled when they get kind of extended, and then obviously dropping below trend like they did at the low in 1982, 2009, and of course 1949 prior to the big, big bull market. So my point in just showing this is that it's important for people to pay attention to the bigger picture. What it implies to me, Blake, is the next high in the market has the potential of being very significant. I believe we're on the cusp of ushering a window of time where the market's going to struggle for 10 to 15 years. We're not there yet, at least I don't think so. But this chart reinforces that longer term, you better be careful in terms of adopting buy and hold strategy because historically, when you see those circles, that didn't end well in terms of buying and holding. And we're talking extended periods, 14 years from 68 to 82, 10 years from 2000 to call it 2009, 9 years, call it that. So anyway, this
Well, why,
just
why,
says
why can't we be there now? Why can't today be the start of it all?
it could be.
Oh,
I
okay.
mean, that's my point. But for me, I need more evidence of a top. And when we look at the S&P chart, we're going to talk about one of the clues.
Okay, there you go. Then I wanted to say you got to stick around because Jim's going to give you a closer view of
More
how
detail.
he.
Yeah. This is just big picture stuff.
All right. Well, big picture doesn't look, that's kind of scary for those of us that are trying to retire in the next 15, 20 years. All right. Well, what do you got here for GDP, AI investment? Okay.
Yeah.
Tell us about
Basically,
this
how
chart.
much is AI contributing to GDP in the first 9 months of this year? It was 1.35%, and it'll be higher by the end of the fourth quarter. If you look at all the other contributing factors, private consumption, well, that's a big part of it. Consumer spending is almost 70% of GDP. You can see, it's hard to see all those, but the little pale blue line, it's on an uptrend. But the point in looking at this chart is looking at the divergence and how much the economy has become dependent on artificial intelligence and all the spending going on to create data centers, power sources, all the rest of it. So the point is that if and when some of this stuff slows down or reality ever shows up that, wait a second, and I talked about this in the November letter. Most of these chips and GPUs that are being bought today have a shelf life of about 2 years. Maybe some will be a little bit longer, some less. So one of the games a lot of the big companies are playing is, well, we're going to expense it instead of over 2 years, we'll expense it 6 years. So what does that mean? When you expense something in 6 years versus 2 years, the hit to the bottom line is smaller. Therefore, it inflates profits. And this is a point that Michael Burry has made over the last week. And again, I covered this November 1st in my letter, that short-term earnings are looking better than maybe they really are because they've extended out 6 years. Well, the problem with these GPUs, they keep, NVIDIA and all the chip makers keep coming up with new stuff that's more powerful, faster. And so the stuff you have from 2, 3 years ago really becomes less valuable. And so by depreciating it over 6 years, they're not recognizing the potential cost to replace the old chip with the new generation that's coming out in 2, 3 years.
Yeah.
And so it does impact earnings to make them look better than they otherwise would. Same thing happened with fiber optics in the late 1990s, Blake. They laid 80 to 90 million miles of fiber optics. The pickup in terms of utilization rates were slow, and the net result, a lot of those companies disappeared. Now, ultimately, all that fiber optic cable was used as technology and the ability to do that. But this stuff, it's a whole different beast. This stuff, you know, loses its value progressively as you get beyond that 2 and 3 year mark.
Yeah.
And yet that's not being acknowledged. And so the impact on GDP and some of the accounting stuff that's being done under the surface, as long as the momentum is positive, people don't care.
Yeah, as long as it's positive for now. Okay,
Yeah.
so the next chart you brought, Jim, is about the University of Michigan consumer sentiment. So
Yep.
tell us, well, tell us
Yeah.
first
Every
of all,
month this thing.
we don't have to look at this crap so much now that we're going to have a government reopening at least for the next couple months. But why does this matter?
Well, this sentiment survey goes back, I think, to 1970, maybe even longer than that,
Mhm.
Blake. And every month grabs headlines because I don't show the final number, but it was down to 50, which is like the lowest ever, going back to 1970 something, right? And so, oh my God, the consumer is cratering, and oh, it's terrible, and okay. Well, when you break it down by political party, you can see Republicans are at 92 and the Democrats are at 42. So this survey, for whatever reason, is truly skewed by political affiliation. And you can see both ways. So when Trump gets elected last November, look at the red line, how much it pops. That's Republicans. All right. Biden gets elected back in 2020. Look at that, the blue line pop. Why? Okay. And what we've seen since Trump, the blue line has cratered. So my only point in bringing this up is that a lot of people look at this survey and then extrapolate it as, wow, it really means consumers are turning really negative. No, you've got a subset of people that really don't like Trump and they think things are going to go to hell in a handbasket. And so it
Yeah.
skews this number. The conference board is up, hasn't had anything near this kind of a decline. And so I look at the consumer confidence numbers coming out of the conference board, Blake, because they don't have this political partisanship bias to both the Republicans and Democrats. So I would ignore this survey, pay attention to the conference board's numbers.
Got it. Okay.
And next week
Well,
I'll try to remember to show that.
okay. Well,
Yeah.
you brought up a chart of gold. So what is
Yep.
this telling us?
Again, my take has been that the high at 43.81 was the top of wave three from the low in 2015, which means we got a multi-month correction. That first pullback, I think, was a wave A. This was a rebound. It exceeded some of the targets that I gave last week. I think, yeah, 41.92. It popped above that briefly this morning. I think that's the end of a B wave, and it's typical. And I expected this because have been so bullish on gold, just because it dropped by almost $500 wasn't going to, oh my God, I'm not bullish on gold anymore. They would look at this as a buying opportunity, and sure enough, my take is the high is in for months in terms of gold at that 43.81 and a 382 retracement of the rally from 1616 to 43.81 is 33.26. So that's why I think ultimately gold is going to work its way below 3,500, which was also the high back last April was 34.96. So, coming back to a prior resistance level, all makes sense. So that's my outlook. I continue to think gold is going to work its way lower because sentiment is still pretty elevated in terms of people being bullish, and I don't think they're going to be rewarded.
All right. Well, they've been rewarded the last couple of days, Jim. That's for sure.
Yeah,
All right.
nicely. Yeah,
They have been. All right. The
yeah.
dollar. So what do you make of the dollar here?
I keep going back to need a close above 100.25. Intraday, it got to 100.36 and failed. And, I think it's important that it holds above that 98 level. That was a recent low. And so if we're going to break out, and so I'm looking at this sideways pattern since really June as being a base building process. And, you know, the signal gets generated when you close above 100.25, and we haven't gotten it yet.
Right.
So I thought 2 weeks ago we talked about it. I said we're a little bit overbought. The RSI, as you see in the bottom panel, was near 70. So I thought we'd see a pullback before we would see the another assault, if you will, at that 100 level. And we've been getting it.
Got it. All right. Well, Jim, this chart is of the S&P, but what's different between this chart and kind of this is the shorter term of what you were
Yeah,
showing us longer term?
this is a handful of weeks.
Okay.
So at 69.20, when the S&P hit that, I think it was October 28th, there were a lot of technical negatives that showed up in terms of breadth indicators and a whole bunch of other things, right? Which
Yeah.
I discussed in my weekly technical review. I mean, some of those things are signals like, 2000, 2007, tops, and so forth. So significant warning signs. At the same time, if you go back since April, the S&P keeps making higher lows. So we saw a low at 65.51. A week or so ago, we had a low at 66.31. What's interesting is, okay, the recent high yesterday, 68.69. Well, that for the first time in a while, kind of a lower high, and we've rolled over. So to me, taking out 66.31 would be well, obviously a change of character in the way the market's traded since April. So, you know, the gap at 67.30, that was, the gap on Monday morning. The 618 retracement of this recent rally, 67.21. So, we're coming down to what I think is important levels. And if we're going to see a higher high above 69.20, to me, these are some of the levels that have to hold.
So, Jim, we're actually starting to make lower highs and lower
Yes.
lows too. I mean, does that mean anything to you?
That doesn't. I go back to the 65.51 because that represented a low and then we went choppily up. So for me, 65.51 is more important than the 66.55.
Got
Your
it.
point about a lower high is important because it would add weight to if 66.31 is taken out. Then you got, wait a second, a lower high, a lower low. That's the definition of a downtrend. So as I said last week, I'm leaning that a top is in, but we need
Need more
more evidence.
evidence. Need more evidence.
Yeah, more
Sherlock
confirmation.
Holmes. Yep. All right.
Ah, yeah,
All right. This is your 10-year notes. We
yep,
just came off of an auction. It wasn't too great. 30-year, I
yep,
believe. So what do you
yep.
what do you make with this 10-year here?
When we talked last week, I noted that on the 10-year, you can see five waves up on the daily. I also showed a chart of TLT, like an hourly chart, where you could see five waves down since that's based on price. This is yield. Um, I think the trend in yields is higher, Blake. There's a lot of supply coming. The fact that the Fed basically said, you know what, we're not going to shrink our balance sheet in terms of treasury paper. We're going to allow the runoff on mortgage-backed securities to the tune of like 65 billion. And that when those proceeds come in, we're going to buy treasury bills. So we're not going to support the long end. In the meantime, we got a lot of supply coming. So to me, I don't see, unless we get, good evidence that the economy's weakening, it's hard to see that treasury yields are coming down. And as I noted at the beginning, we've had at least five different FOMC members talk about, and people who voted for the last cut in October are pulling back and saying, I'm not on board for that December cut. So that's where so I don't think that's helping the treasury market, but the key level is 420.
All right.
Um,
We
yeah.
break through we break through that. That means yields are going up and maybe the dollar follows. Maybe.
That's kind of been the pattern.
Yeah. All right. Well, speaking of which, well, not of which, here is Bitcoin. And we're
Yes.
so excited to take a look at Bitcoin. How do you see in Bitcoin?
Well, this is just going back, I think the last year or so on Bitcoin, maybe longer. I can't read the bottom of the chart over there on the left,
That would be
but
February of 2024, end of
yeah,
2023. Yeah. So,
yeah, okay. So a chunk of time,
yep.
it made that low and then it worked its way higher. That green trend line is just obvious. It's like, okay, let's connect all the lows. Well, where does that come in? Around 92,000, give or take a little bit. So, are we going to go down to 92,000? My bias is yes. And then the next chart looks at the short-term pattern and why that supports that. So, Bitcoin dropped from 126 and change to 103, $22,572. Then it rebounded to 116. If you subtract that first drop from the high at 116, the target's 93,637. So I think the odds are Bitcoin's going to get down toward that trend line, and then we'll see what kind of support comes in. My assumption is it will get supported, Blake, and there will be a rally. I don't think it's going to a new high, after that. But we'll cross that bridge when we get there. So
Right,
near
right.
term, I think it's short term, it's gonna head south more.
Okay. Well, the last one is Crude. And Crude, this is an interesting chart to me, Jim, just because there's a point in the market where fracking becomes unprofitable, and a lot of
Yep.
people draw the conclusion it's around $55. we're getting real
Yep.
close to those levels. So I mean, what do you make of all this?
I just think, Saudi Arabia and OPEC said, well, yeah, we're going to increase production. It wasn't by a lot. But obviously the pattern, it's in a downtrend. I mean, just look at the two green lines, which encapsulate the trading going back the last chunk of time. Can't remember how far back this I went on this chart. It's at least maybe a couple of years. I don't know. So my guess is, in all likelihood, we'll see a drop towards that green trend line. Now we're in a time of year, obviously. If you go back and look at a multi-year chart of crude oil, you'll see in December you get sometimes some pretty good rallies. It didn't happen in 2022. It did in 23 and 24. You get huge cold snaps, and that just kind of causes a combination of short covering, some buying. But I think the odds are we're going to head south and get near that trend line. And at that point in time, the RSI will be oversold. If it breaks below that trend line, all of a sudden 45, crazy. I mean, if you really get an economic slowdown, 40, So I just think there's no compelling reason right now to expect oil to rally in a sustained way over weeks and months at this point in time, because I think near-term supply is there's just too much.
Jim, one of the ways that I looked at it too, though, is, right now, and of course, we haven't had a bunch of economic data, but right now, I mean, I view us in, kind of an expansionary type of environment for globally, well, maybe more steady. If we start seeing
Yeah.
recessionary type of data, wouldn't that put some downside pressure on crude oil?
Yeah, because if you're an oil trader and you say, "Whoa, wait a second, looks like slowing is going to, globally, obviously, if the U.S. and Europe, whatever, um, you're going to sell crude oil. Why? In anticipation that less demand automatically equates to more supply. And
Yeah.
OPEC has said they're going to be holding the current production levels through, I think, the first quarter of next year. So we seem to be edging toward uh, market share battle as opposed to anything else. And, behind the scenes between President Trump and Saudi Arabia, um, is Saudi Arabia kind of being helpful to Trump from a standpoint of by Israel getting rid of some of the major terrorist groups, ushers in some stability. Iran has kind of been pushed to the back burner. That Saudi Arabia kind of like, okay, we'll help you, in the sense of we'll increase production and get energy prices down, because Trump wants that in terms of inflation and so forth. So we just can't, I'm just surmising that
Yeah.
behind the scenes. Now, remember, before the October 7th, you know, massacre of Israelis by Hamas, you know, Saudi Arabia and Israel were really getting close to signing an agreement and becoming much closer. I think that was one of the triggers of why Hamas did what it did, was to try to disrupt that. And it did. But maybe potentially now, um, getting rid of Hezbollah and neutralizing Hamas, and again, Iran and its nuclear threat, at least for a while, I think Saudi Arabia isn't upset about that at all.
All right. Well, let's see if they can continue to assist the administration. So, if you
Who
will.
knows?
Who knows? Well, Jim, I appreciate you bringing, and I know I'm not the only one. I know our viewers appreciate you bringing Bitcoin and crude oil to the table. And if you guys want to see something else that Jim, have Jim look at, no, not your penny stock. How about something that is kind of an asset that everybody's looking at, whether it's the Japanese yen or maybe copper or something that's like, some asset that you think everybody should have their eyes on, why don't you bring it to our attention down
Yeah.
below, or Jim's attention down below in the comments below. Jim, what's the best way for traders to get a hold of you?
Jim Welsh Macro at Gmail, and I'll send you a recent report.
All right.
Especially the November macro tides, Blake. I did a really deep dive on the artificial intelligence. It is a big deal, but I think we need to really understand that it might be being oversold or relative to where we're going to be somewhere down the road. So anyway.
Jim, you're just an alarmist. You're just an alarmist that's been through the dot-com bubble. How about that?
Well, there's parallels.
There
You
are
know,
parallels. No,
there are. And again,
I
when
think they
something
are.
becomes so dominant, to me, it just necessitates really staying on top of the story because you have a lot of people have bought into the story. At some point in time, the story changes. It always does.
Yeah.
I don't think we're there yet, but what I wanted to do is pinpoint some of the reasons and some of the catalysts that are going to come, I think, and we're already seeing it, ironically, very quickly. And I'm
Yeah.
not sure I think the critical mass of people being excited about it, I think that's still intact.
All right. Well, Jim, I thank you for your time, and I know everybody else does. And if you do, make sure you give Jim a thumbs up. Subscribe to the channel. It is free to subscribe, so you can get this exclusive interview with Jim each and every week. And jump down in the comments below. Tell Jim hello, even if you don't have something for him to look at. Jim, thank you for your time, and we'll catch you next week.
You got it, Blake. Stay well.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.